Welcome to Turning Hard Times into Good Times. I'm your host, Jay Taylor, speaking to you here from New York City on the 27th day of February 2018. I do want to remind you that I'm the author of Jay Taylor's Gold, Energy, and Tech Stocks, and would like you to subscribe to my letter at miningstocks.com or you can call our number here in New York, 718-457-1426. 718-457-1426 during normal work hours. Chen Lin's letter also is one that I highly recommend. You go to chenpicks.com. Chen has had a remarkable track record, and his focus is more on the biotechs and some on the energy stocks as well. He also does follow a number of gold mining issues, too. A very successful investor. You may want to consider subscribing to his letter. I do want to thank each of you for listening to this show, making it one of the more popular shows on the Voice America Business Channel. And also send your questions, comments, criticisms, and praises along to questionsfortaylor@gmail.com. We do need to thank our sponsors for making this show economically viable. Our sponsors for this week are RN Resources, Dynacor Gold Mines, Genesis Metals Corp., New Range Gold Corp., Northern Empire, Novo Resources, and Uranium Energy. Now, I do have a couple of notes about a couple of our sponsors. First of all, Northern Empire announced yesterday a very strong drill intersection, 123 meters of 1.41 grams per ton gold. And Michael Allen, the president and CEO of that company, was on this show on February 13th. I would suggest you may want to go back to listen to what he had to say at jtaylormedia.com. Go to the podcast page at jtaylormedia.com to listen to that interview. I will be commenting as well on this stock this weekend in my newsletter. It is a company and a project they have in Nevada that definitely has the potential to become extraordinary, in my view. Carlin-style mineralization, and I think this drill intercept is just one more indication that they may be onto something very, very substantial. Now, today, Novo Resources is one of the few gold stocks that's up, and it's been up about 9 or 10%. During the whole trading session today, going counter to almost all the gold stocks, which are really getting hit rather hard as interest rates have climbed and the stock market is down in general. A very interesting day for sure, but that Novo is able to counter the trend is very interesting, and I'm also pleased to say that we'll have that company's president and chairman, Dr. Quinton Henning, will be with me after the first commercial break. Before I talk about today's show, let me tell you that I interviewed David Stockman this past week. He explained why not only is there no way out of this financial market turmoil that lies ahead, that because of the creation of the debt-based money, the Fed over many decades, we are now facing the mother of all financial crises in David's view. So I would also suggest you can listen to that very interesting, I think very insightful interview at jtaylormedia.com. Again, the podcast page at jtaylormedia.com to listen to my interview. It was recorded last Friday with David Stockman. Today's show has been titled, When Will the Next Credit Crisis Occur? Alistair McLeod, Michael Oliver, and Dr. Quinton Henning will be with me this week. Now, for investors, there may be few questions more important than the one Alistair has attempted to answer in his recent Gold Money essay, titled, When Will the Next Credit Crisis Occur? When the next credit crisis hits, most asset prices are likely to decline dramatically in value as they did in 2008-2009, but which ones are the most vulnerable and which assets might actually protect you from those losses? How will gold fare in the next credit crunch? Well, that is certainly one of many questions that I'll have for Alistair, but right now I'm going to ask that question of Michael Oliver, who's with me again. Thanks for joining me, Michael.
Good to be back, Jay.
Always good to have you, and it's always good to tell my listeners that your website is olivermsa.com, olivermsa.com, and it's good to tell them that because I value your work so highly, which is why you're with me as often as I can get you on the show, and that's almost every week, so I'm really glad that you could be with me again. Michael, I interviewed, as I just noted, David Stockman last week, and again, that's posted at jtaylormedia.com. David looks at this enormous amount of funding that is going on. It's going to be required by the Fed, by the Treasury, that is, at the same time that the Fed is pulling money out of the system. Now, David said he is quite certain the Fed will be raising rates at least 4 times this year. He noted that the next fiscal year, even with the optimistic estimates of government, we will have a $1.2 trillion deficit that's going to have to be funded, plus the Fed will be pulling back $600 billion out of the economy as it tries to normalize its balance sheet. David's view, which is based on fundamentals, has the treasuries rising to 4.5% to 5% or so. So David is seeing a whole lot of gloom and doom ahead of the bond and stock markets. Now, what I value about you is not only your accuracy, but your dispassionate view of the markets. I mean, I told you a little bit ago that Jerome Powell was at Capitol Hill for the first time today, and he said, "Oh, was he? You didn't care much because, what the politicians do and what we hear on the surface isn't really all that important to you. But what you do, your dispassionate technical analysis, your momentum, structural analysis has just been spot on. So I have to ask you, what are your thoughts?" About some of these key markets now as push comes to shove. I mean, we have huge amounts of financing that need to be funded and less savings to fund them. So what about treasuries, stocks, precious metals, some of those markets? How are you viewing them now, Michael?
Well, we turned bearish on T-bonds in October 2016. T-bond futures then were 166. They're now at 143, 144. We got mega bearish at the close of January this year, when price closed at 148 or lower for the monthly close. That broke another major, massive structure on annual momentum of T-bonds, which tells us that not only is the bear underway, it's underway with a vengeance. Now, that doesn't mean you can't have counter-trend rallies. In fact, we kind of expect one now. But they're counter-trend. They're to be ignored. They're to be sold into at some point. Mm-hmm. We think that there's a lot of confusion right now, I think, on a day-to-day basis, and I think it's largely due to the fact that finally stocks got gut-kicked. And when they dropped suddenly. They even dropped more than we thought they would in the initial break, and the wind came out of the market. Now, they've come back up easily, halfway back to the highs, a third of the way to the highs, some even more, like the NASDAQ 100. But we watch all the developed market indices. That's to say Japan, Europe, and us. Europe is below levels it cannot close out this month. I'm talking UK and Europe. The FTSE 100, the DAX index, so forth. They're at levels that are not permissible on our quarterly momentum studies that says, you not only slipped, you slipped below levels that broke something. You're staying below them. The U.S. rebounded back above them intra-month, but broke them nevertheless, and I think it's a wounded market. And I think the violence that you're seeing in the stock market has created confusion in other markets about what to do. What does it mean? And therefore, it's like if I grabbed a tablecloth and there was a lot of silverware and china on it, it all flips up in the air and shatters. So you have confusion, chaos, breakage. And therefore, with the lack of order in the market, both on the upside and downside, there's a lot of confusion. In the case of gold, it's hit the gold market a little bit today. I mean, we waver in between 1310 and 1350 for the last month or two. But basically, that's a fairly tight zone if you look at it on a percent basis. And it's all at the upper end of the last 2 years of trading range. So put it in context. So gold is taking it fairly well. The one area I'm most excited about is the grains and the food commodities, because they didn't care one whit about what was going on in these other markets, because there's no investor emotion attached to things like live cattle, corn, soybeans, and wheat. They've come up, and they're closing right now. If they close out tomorrow, the end of the month, if I'm not mistaken, where they are now, they're creating annual momentum breakouts across the board, which tells me that the food commodity complex, the area that's so sedate it's boring, is about to explode. And that's an area that most people aren't watching. That's an area I think there's the greatest percentage potential gain in a short period of time. Not that it's going to end in a short period of time, but the first surge should be quite beneficial, 30 to 40%, I think. And it is one area that has not been disturbed by the recent stock market rattling, unlike most markets. So I'm very pleased with what I see, and I think to some extent investors need to stand back, not pay too much attention to the day-to-day in things like T-bonds and gold. Instead, keep in context what is the major trend, and the current action is not violating that, namely bonds down, meaning yields higher, gold up despite the congestion, and now it's being joined by the food commodities, which is a major element for the global population, and in terms of your metrics of what inflation is doing or not doing. And so I'm really quite happy with what's going on. As far as developed market stocks go, the S&P, I think it'll resolve downside, but I think it has to be almost by nature so irregular that it confuses you most of the time.
Yeah.
Because if it were easy, everybody'd be short. Okay? It's got to be confusing. And we kind of thought that's the way it would unfold anyway, because there's been so much intense watching of the stock market by investors and participation that when it does come undone, it's got to come undone in a way that's not obvious or is confusing. And it certainly looks that way.
Yeah, well, it's very consistent with David Stockman's remarks to me last Friday as well, Michael. He suggested that he thought it would be a choppy downward market, that in fact people will continue to look to buy the dips. There's enough of that sort of notion that you can still, when the market gets smacked real hard, you can go back in and it's onward and upward again.
Have we got another minute?
Yeah, we do, sure.
Okay, I was going to say something about Stockman's commentary. There are a lot of mega bears out there who are always bearish. They've been that way for 10, 20 years. You know, the world's going to come apart.
Right.
Stockman is a very flexible guy. I've read his stuff. I like what he says, and I like the fact that he moves with the realities, not with some constant theme.
Yeah.
But I happen to agree with him on a technical basis with his fundamentals, and I think we're at a point now where we've undergone many, quote, crises, debt crises, stock crises over the last, since 2000, that we survive, that don't coalesce into something grand. And I think this time around, the pieces are set such that when this time we have the crisis, whether it's credit related or whatever, I think many pieces will move together. It will be not just be isolated to the housing area. It'll be so widespread that it'd be like the end of a symphony, okay? You know what I mean? It's all coming together. I think he's right on that point.
Well, I think that's very consistent with what David thinks, the mother of all bears, unfortunately. But, you know, Mother Nature has to have its way ultimately. They can play with it for a while, but ultimately Mother Nature wins out, I think, and you certainly are a believer in that, Michael. I want to thank you very much for being with us again. Always, your insights are always so important to us, and thanks for being with us again.
Thanks, Jay.